Good morning and welcome everyone to the Moneycontrol live stream. You're watching The Opening Bell and I'm your host Nickey Mirchandani. Well, the Wall Street looks set for a soft start in the earnings heavy week. Nifty futures on the SGX indicate a mildly negative start coming in for Indian equities. Wall Street ended higher after the major averages rose to kick off a stacked week of corporate earnings. Asian stocks at this point of time are trading mixed, with China GDP surpassing expectations. FIIs, they've sold out, probably reversing the long buying streak that they've had just far, but the amount is minuscule to an extent of around 533 odd crore. DIIs, they have bought in shares worth around 269 odd crore on April 17. WPI dropped to 1.34% in March, the lowest that we have in 29 months. In terms of earnings that we'll be keeping a close eye on will be ICICI Lombard General Insurance, expected to be in focus. But let us get going and discuss some stock and strategies today with Pritesh Mehta, Senior Vice President Research at Yes Securities. Good morning there, Pritesh. Your strategy on Nifty along with the mid-cap index, the broader index, we've seen some amount of selling pressure that crept into the markets after Infosys delivered a disappointment. How do you see the markets right now and your strategy both on Nifty as well as mid-cap Nifty before you give your strategy on Bank Nifty?
Yeah, good morning, Nickey. Now, see, prior to yesterday's fall, we had seen a rally of 1,000 points on index. So I think it's time to take a break. We have seen a run up in last 15 days, and if you look at the levels from 16,800 levels, we have seen a change in orbit to 17,700 plus levels. So I feel now the focus should be on the broader markets, on the mid caps, rather than focusing on the large cap stocks. Because when you look at the ratio of the mid cap and mid cap versus Nifty index, it is bouncing off the support zone. The moment it goes above the ratio of 1.76, we can that is equivalent to the Feb high. We could see mid caps outperforming. So if you look at the standalone chart of even the Nifty mid cap index, it is bouncing off 2-year mean. Now from here on, I'm expecting mid caps to do well. In fact, when you look at the seasonal data of mid cap index in the month of April of last 16 years or 13 of which it has got positive returns. So I think next 2 weeks it has to be about mid caps.
Sure, Pritesh. Also, your strategy on Bank Nifty right now, and what do you make out of Infosys also after the recent drubbing that the stock has witnessed? Do you think it's a good buying opportunity out there?
Now, see, when it comes to Bank Nifty, rather than being focusing on the likes of index heavyweights like HDFC Bank or Kotak or ICICI, I think there's plenty of opportunity taking place in the PSU basket. For benchmark Bank Nifty, I'm expecting it to rally towards 42,800, 4900 zone. But the PSU Bank Index is the one which we need to keep an eye on. Something like Can Bank, Bank of Baroda.
Sure, we'll get on to that later on. But let's actually first address the markets open for you right now. Nifty 50, we're looking at the top, some amount of positive momentum coming in on that one. We'll get back to Pritesh and ask about the strategy later on Bank Nifty as well. 0.2% out there. Bank Nifty Index 2 is holding up the neck in green, 0.2% out there. So clearly, after the initial drubbing, or the little breather, if I may so say, the momentum has again resumed when it comes to Nifty and Bank Nifty Index overall. If you talk about the sectoral indices right now, Nifty IT, it's flat with positive bias. Along with that, if you look at the other sectoral indices, just to see how the flavor has been stacking up, auto, 0.4% out there. And if you talk about the other sectoral indices, something in the likes of pharma, FMCG, pharma down and out with 0.2% out there. And if you talk about the metal index, that's holding up for you. Some amount of resilience seen with that pack overall, 0.3% of gains out there. And FMCG basket right now, it's trading flat with negative bias right now. If you talk about the market breadth, well, if you advances 32, declines 18. So looks like bulls are back in control and not giving up just as yet, even after the initial amount of breather that we've seen. If you look at the top gainers and the top losers out there, housing finance companies, they're expected to be in focus out there. But let's address the top gainers and the top losers just to understand if Infosys has also recovered from what we've seen. Nestle India, Tata Motors and Adani Ports. These are some of the top gainers that we have on our list out there. And in terms of the other gainers that we have on the list right now, it includes the likes of something like, Tata Motors, of course, has been playing up. Yesterday also it was up in trade after the hike came through. Nestle India is a bit of surprise out there. The FMCG basket has started, is trading up and above. Adani Enterprises, Hindalco, and HCL Tech. So that's where the recovery is coming in. Maruti Suzuki, Grasim, and L&T. These are some of the other top gainers that we have on our list right now. So it's auto basket which is doing well, and some amount of recovery coming in from even HCL Tech. Cipla, Apollo Hospital, and Hero MotoCorp are some of the losers that we have on our list right now. And if you, also talk about TCS, Sun Pharma, and ITC, these are some of the other losers that we have. But before we get deeper into the discussion, I'd like to address housing finance companies and Angel One. Morgan Stanley has initiated a report on affordable housing finance companies. It says that the space is right now niche, underpenetrated, and the sector has a very secular growth outlook. The thesis is stronger when it comes to the asset quality, which has been tested by COVID valuations. At this point of time, valuations, they've been derated and the peak rates are in sight. They prefer Aptus and Home First Finance, given the smaller balance sheet, higher loan growth potential, as well as better business risk, return profiles, and valuations. These are some of the fundamentals why they have picked up the 4 stocks that I'm just going to, list it out for you. Aptus value, overweight rating, target at around 325. Home First Finance, overweight rating, target at 900 rupees. Awas Finance, equal weight rating, target at 1,900. And Canfin Homes, equal weight rating, and the target of around 550. I also want to talk about Delhivery. Bernstein has initiated a market perform rating on Delhivery, target at around 360. It says it's a secular story, but the returns have been capped. There has been corrective actions which have been taken in recent months, which is expected to drive a recovery in the earning, the stock recovery. However, there is a long queue of PE exits. Right now, Delhivery up on the screen for you, gains of around 1.5%. Yesterday, we spoke about Paytm. Today, we are talking about Delhivery. Looks like new age companies are again coming back in vogue. Zee Entertainment, that's another one on the list out there for you. Block deal happened yesterday. Siganti India Mauritius, Morgan Stanley, and Goldman Sachs. They've picked up 640 odd crore overall in the basket, and we've seen some amount of exits coming in from OFI Global China Fund, which is completely out of the company. They exited their stakeholding, and with that, the overhang is also out and done and dusted for at least Zee Entertainment. Angel One is another one that I'd like to address. It's a strong quarter coming in for Angel One. They say market participants make money or no, but the brokers will always make money, and Angel One is an example to that. Q4 numbers, net profit up 30% at a number of around 267 odd crore as compared to 205 odd crore. Revenue up 21% there for you. And EBITDA is also up by 30%. Look at the reaction. It's a sharp reaction coming in on the Angel One. Strong quarter delivered. Gains of around 5% out there. Pritesh, coming back to you. Your strategy right now on Bank Nifty, you spoke enough and more about the mid-cap index. But right now, your strategy A on Bank Nifty, and also a word coming in on HCL Tech, because that's one of the gainers that we have in today's session.
Yeah, as I was saying earlier, for Bank Nifty, we need to focus more on the PSU backing side. When we look deeper into the space, likes of Bank of Baroda, Can Bank still have the opportunity or the potential upside of 10% from here on. And for Nifty Bank, the benchmark index, it can go towards the levels of 40 to 800 levels from here on. But the focus of attention should be the PSU banking basket. And when you look at the IT space, I think we are in for a round of underperformance. We already saw Infosys underperforming, track coming down sharply. HCL Tech in particular, I think it would be the second one in the list. I think if you look at the chart patterns, there is a bearish total breakdown taking place in this particular counter. So I'm expecting further more downside pressure coming in. This recent recovery won't last for this counter.
All right, Pritesh, I think you're completely running out of time there, so we'll leave it at that. Thank you so much for taking out the time and speaking to us as always. All right, so that's the word coming in, but let's actually do a quick check on the markets and let's look at how Nifty, IT, Infosys, HDFC Bank, ICICI General Insurance, some of these stocks are doing, just to get a flavor of whether or not we've seen some amount of recovery creeping into the markets right now. Nifty 50 right now, some amount of gains have been given up, but still holding its neck in green for you. 0.1% of gains coming in on that one, 17,700 mark. That remains stable. So that's nothing to worry per se when it comes to the momentum that the bulls have continued to have. There's a bit of breather after the 9 consecutive sessions of rally yesterday with the amount of disappointment that was delivered. But clearly, you know, the bulls have taken back the control overall for the markets. Let's look at Infosys and what Infosys is doing right now along with RIL. Infosys saw amount of losses to an extent of 10, 11, 12%. You barely get to see that amount of losses on counters like that, right? I mean, one would argue that it also could be good buying opportunity, but given the demand environment right now, Infosys is seeing some amount of recovery. So 2/10, nearly less than 0.5% of gains coming in after the sharp losses that we've seen. You know, for the IT pack, most of the analyst community, they've downgraded the entire basket per se, and they see more pain coming in for overall the mid-cap space, which at this point of time are more vulnerable to something like a vendor consolidation and also something like a demand environment which continues to remain very, very uncertain. BFSI is where the pain is coming out from. North America is probably the pain point in terms of geography. So, but that's that in terms of the Nifty, IT and the Infosys. Of course, we can also look at HDFC Bank before we swing our conversation to Gaurang Shah, who's going to be covering in the fundamental side for us, just to see how HDFC Bank is doing. It's right now holding, it's a flat bias out there with some amount of negativity out there. But we have Gaurang Shah of Geojit Financial Services with us. Good morning there, Gaurang.
Morning, Nickey. Good to see you.
Same here. Thank you so much for joining us from Ahmedabad. I'm sure you've been caught up there for long haul. But what sense do you now make out of IT companies? Do you think something like an Infosys, something like an HCL, or for that matter, Tech Mahindra, do you see a buying opportunity with these kind of names, given the kind of corrections that we've seen and the valuations that now are almost coming back to the 3-4 year averages thus far?
So, Nickey, our sense that Geojit is that if you're not looking at short to medium term hurdles or speed breakers or the concerns in terms of deal pipeline and the numbers, then from a 1.5-2 year kind of time horizon, our sense as Geojit is that given the price correction before the third quarter numbers that we saw, and of course with the fourth quarter numbers historically being on the lower side, it's not only this or last financial year, but if you look at the historical performances of a fourth quarter every financial year, then IT sector has been below the weather. There is no rocket science about it. And given the correction that we have already seen in the IT sector or the IT techs, I think this is time that I'm not saying that you should jump into the sector and start buying, but at least allocate 15, 20, 25% in a staggered manner and look at buying into IT sector with a 1.5-2 year kind of time horizon. I mean, there is undeniably a lot of headwinds in the near future, but are these headwinds going to stay for a prolonged period of time? If you ask us, we don't think so. So starting with TCS, HCL Tech, Tech Mahindra, Infosys, Persistent Systems, LTI Mindtree, KPIT Tech, Tata LXI, Coforge, Sant Limited, entire universe, we have a positive coverage and we are maintaining that. And we are maintaining that and we are advising all those investors and our clients who have 1.5-2 year plus kind of time horizon to start nibbling into the IT sector.
Start nibbling into IT, 58% of allocations is what the investor community can look at after the recent set of correction, is the word coming in on the IT space. I must say it's quite a contrarian bet out there because most of the analyst community are right now looking at more price compressions coming in and even bleaker outlook coming in for the second half. If not for bleaker outlook, they're not expecting things to kind of quickly recover, because even the slight shadow of the word recession in the US will probably let the clients behaving in the way that they've already gone ahead and did the cancellations out there Infosys, said that in the commentary. Don't you sense any amount of caution from those commentaries, or you expect second half to be better for IT companies as compared to what the street is anticipating?
So, I'll put it in this way on a lighter note. You can look at it as the glass is half empty, or you can look at it as glass is half full. And this world is made up of two kind of, people, persons rather. One who agree, one who disagree. And it always takes two to tango, Nikhil. There is no doubt about that. So, and even in stock market across the world, if everybody agrees, then you don't need the other person. So you need to have certain section of people disagreeing to what the other section is saying. That's what I said, Nicky, that if you're not looking at next 3, 6 months, 9 months, headwinds or speed breakers, or the negative environment under which the IT sector is performing, and if you have 1.5, 2 year plus kind of time horizon, I think with that kind of a time horizon, and given the backdrop of the complexities that the IT environments work in, along with that, you take the kind of cyber attacks, kind of scams that are happening. All this will lead to all the companies, whether it is a small cap, mid cap, large cap, domestic or an international company or an MNC, to safeguard and have an IT environment or a platform where consumers and users can use it freely without any fear of data loss or any kind of hacking or any kind of scam that may happen. So you will need services and products of these companies. Yes, I agree that near term there are problems, but if you look at long term, then there are opportunities.
Sure, Gaurang. You're clearly from the camp which believes that the glass is half full because of the view that you've given on the IT basket thus far. But let me also chat about the housing finance companies. Morgan Stanley has initiated, a report, a buy rating on most of the companies, in fact, overweight for some of them. And that includes the like of something like an Aavas Finance and Canfin Homes. What do you make out of it? Do you see it's a secular growth story, untapped market, more niche segment, and thus valuations look attractive? How are you looking at the counters right now?
So let us first look at the interest rate scenario, Nicky, because that is very prudent to look at. We are coming out of an environment wherein we had consecutive interest rate hikes because of a lot of domestic and international news flows and data points. With the coming